Hey guys, it's Brian. Welcome to Financial Fitness. If you're new to the channel, please subscribe. In this video, I'm going to talk about cutting your investment losses, tax loss harvesting, and how it might impact your investment portfolio. Please do your own research or consult a financial advisor, CPA, and accountant if you need help with your investment portfolio. Let's get started. Before we get into tax loss harvesting, you'll need to understand the art of cutting your losses to be able to identify what to stay invested in versus what's worth selling. How do you know when to hold or when to fold and sell your stock position? No one is intentionally going to buy a stock that they believe will go down in price and be worth less than what they paid for it, except investors that short stocks, but they're technically borrowing stock to sell. More on that in another video. Buying stocks that drop in value is an inherent risk of investing. So the goal is to minimize losses by investing in fundamentally strong companies, but even then, some stocks may not cooperate just because you're invested in them. Sometimes your only option is to realize a capital loss before it gets out of hand and understand that a stock may not rebound in a reasonable time frame. Being able to identify what a reasonable time frame is separates successful investors from everyone else. When taking a look at your investment portfolio, stocks with large losses over 30% relative to how much is invested in each is pretty much dead money or dead weight. At the best, it can stay around the same price and value, or at worst, it's like an anchor that can potentially drop further in price and value. Every now and then you may have one that rebounds, but again, that depends on the time frame. Examine your investment strategy with your overall portfolio and any stock that you're invested in before jumping to any conclusions. Is the company lagging in performance due to a specific factor, or is it something else holding it back? There are three pitfalls that can happen with investors typically when holding stocks that are down for extended periods of time. The notion that stocks always rebound, refusing to take a loss and hoping to break even, neglecting portfolio rebalancing. The idea that stocks always rebound, while that may be true in many instances, especially if you look at various stock indexes like the S&P 500, they don't always hold up for individual stocks. Maybe the stock that you're invested in was at one point in an index, but was replaced with something else for no longer meeting specific requirements or dropping in value. There are plenty of companies that never reach their all-time highs again, and some that get delisted from stock exchanges or even go bankrupt. By constantly thinking that all stocks will eventually break even, you fall into a fallacy that may never work out. Instead of keeping the investment for too long, longer than probably 2 years of poor performance, it would be better to take a loss and invest in something else that could potentially provide better returns. The time in which you might be hoping that a losing stock could break even, you're losing time that the same money invested in that losing stock could be invested in a stock that is growing in price instead. Some investors may even take the approach to neglect their portfolio because they don't want to look at the stocks that are lagging compared to the rest of their investments. By allowing certain investments to spiral out of control, you run the risk of losing interest in managing your portfolio regularly and sticking with your investment strategies and goals. Try to rebalance your portfolio at least once or twice a year to stay on track towards your financial goals. Now that I've gone over the pitfalls that investors might face with stocks that might perform poorly over time, here are some reasons to take a loss or realize a capital loss on a stock. Have an investment strategy for your portfolio. How does each stock fit into your strategy? Have specific reasons to sell a stock or buy any stock. Set price targets to sell any stock or buy any stock. Would you buy the same stock at the current price, assuming it's lower? Always keep your overall investment strategy in mind when adjusting your portfolio. Your portfolio strategy can be based on fundamentals or technicals or other macroeconomic factors. But don't lose sight of this even if certain investments might be at a loss when reviewing your portfolio. Think about how each stock fits into your portfolio. Are you trying to invest within specific sectors, or is there another factor that makes you like a particular stock over another? Generally, it's easy to buy a stock, but knowing when to sell is much harder. So you should have specific reasons to sell a stock. There is a certain element of greed as stocks rise to just let it ride. Stocks can drop way faster than they can climb, so if you set specific reasons and conditions to sell a stock, do so when those conditions are met. It could be anything from analysts starting to change their ratings on the stock, if there are any acquisitions that the company makes that don't make sense to you, or if their earnings start not meeting expectations, and so on. Just like setting reasons to buy and sell, set targets to buy and sell a stock to make sure you keep your profits and minimize your losses. And in my opinion, one of the best indicators would be if you are reviewing your portfolio and a specific stock is down from where you purchased it, assuming you didn't already own it. If you wouldn't buy it at the current price that it is now lower, then it's time to sell. In December of most calendar years, you may see some odd trading activity around stock prices in particular. And part of that will be due to tax loss harvesting from investors rebalancing their portfolio and getting ready for tax season in the new year, or making some early predictions of what might perform well in the next calendar year, in contrast to some that didn't perform well in the current calendar year. Tax loss harvesting is a strategy that changes an investment that has lost money into a tax benefit. That is the core of tax loss harvesting, and it can potentially help you reduce taxes now and in the future too. Sometimes an investment that has lost value or has not performed like you had hoped might not be so bad after all. By implementing this strategy, selling investments that are down or at a loss to reduce your investment gains can be beneficial for tax purposes. Investment gains can be offset with the losses from the investments that were sold at a loss, and then offset by your realized investment gains. The result is that less of your money goes to taxes and more can stay invested and continue to work for you. Tax loss harvesting tends to happen largely in December, when portfolio rebalancing occurs before the start of a new calendar year. But this approach is effective throughout any part of the year to optimize your gains and losses for tax purposes, not just towards the end of the year before tax season. Be mindful that not every investment or stock that is losing money is a candidate to be sold or for tax loss harvesting. Consider investments that have performed poorly with little hope for growth in the future, and investments that no longer fit into your overall strategy. Also consider investments that can be substituted for something fairly similar to maintain your diversification and still be invested in the sector that you like to begin with. When harvesting losses to maximize your tax savings, look for short-term losses first, since they will offset short-term gains and can provide the highest tax benefit, given that short-term gains are taxed at income. To better understand how to take advantage of tax loss harvesting, you'll need to know the differences between short-term versus long-term capital gains and losses. In addition to gains and losses, you'll need to know how wash sales work and how to avoid wash sales. If you haven't seen my video on wash sales, please check out that video where I go into details with examples of how wash sales can be avoided and what happens if you encounter a wash sale. This is relevant to portfolio rebalancing, overall portfolio management, and tax loss harvesting. Keep tax loss harvesting in mind throughout the calendar year to optimize your portfolio for gains and tax efficiency. To distinguish what counts as long-term versus short-term is whether you have owned it for more or less than 1 year. Any investment owned less than 1 year is considered short-term, and any investment owned longer than 1 year is considered long-term. In order to get the benefit of long-term capital gains tax treatment, holding investments at least 1 year or longer will be the most tax efficient. Short-term capital gains are taxed as income, which maxes out at 37% on federal taxes, while capital gains is 0, 15, or 20%, depending on the size of the capital gain. You typically hear 15% more often than not, and that's because the size of the profit has a fairly large range for 2020, from $40,000 to $441,000. On top of either income tax or capital gains tax, which is a federal tax and applies no matter which state you live in, there are also state and local income taxes as well, which only adds to your tax bill. Some state and local taxes do not distinguish between long-term or short-term gains, so keep that in mind and check with your CPA or accountant. Based on the tax code, long-term gains and long-term losses will be netted against each other, and then short-term gains and short-term losses will be netted against each other. Essentially, gains are losses of the same type. But if your losses of one type exceed your gains of the same type, then you can apply the excess to the other type. For example, if you were to sell a long-term stock position at a $10,000 loss, but had only $5,000 in long-term gains for the year, you could apply the remaining $5,000 in excess losses to any short-term gains. If you have harvested or realized short-term losses by selling, but have only unrealized long-term gains, you may want to consider realizing those gains in the future. Generally, the least effective use of short-term losses is to apply them to long-term capital gains, but depending on your tax situation for that calendar year or the size of the capital gain, it may still work out better to pay the long-term capital gains tax. If you sell a stock and realize a capital loss, it can be effective whether you realize capital gains this year or not. Since you can carry losses forward into the next calendar year, the tax code allows either joint filers or single filers to apply up to $3,000 a year in capital losses to reduce ordinary income. Check with your accountant or CPA to see if they are already doing this for you. And no, it can't be any higher than $3,000 per year currently. If you still have capital losses after applying them first to capital gains and then to ordinary income, those remaining losses can be carried forward for use in the next year or even future years. The three ways in which tax loss harvesting can help you manage your taxes are: investment losses can help you reduce taxes by offsetting gains or income. Unused losses can be carried forward indefinitely. Even if you don't currently have any gains, there are benefits to harvesting losses throughout any calendar year, since they can be used to offset income or future gains. If you have more capital losses than gains, you may be able to use up to $3,000 a year to offset ordinary income on federal income taxes and carry over the rest to future years. To further fine-tune your investing, you may want to consider choosing the best cost basis method for you, and your options are average cost basis or actual cost basis. The actual cost basis should allow you to designate the highest cost shares to designate for selling and realizing a slightly larger loss than the average cost basis method. The average cost basis method is easier to keep track of when managing your investments, but that also depends on how frequently you trade. Personally, I like the average cost basis method because it's easier to keep track of, and the extra amount that you can claim for losses does not outweigh the ease of tracking the bunches of shares purchased for me. If you have bought multiple bunches of the same stock over time, either through several purchases or dividend reinvestments, your cost basis can be calculated either as a per share average of all the purchases, the average cost method, or by keeping track of the actual cost of each bunch of shares, the actual cost method. Don't lose sight of your investment goals just because of tax loss harvesting. Maintain your portfolio diversification by reviewing your portfolio at least once a year. You can even review it more frequently, like 2 times a year, or even quarterly, which would be 4 times a year. This way, you'll be able to take advantage of different opportunities to either add investments to your portfolio or rebalance throughout the year based on your goals and investment strategy. If you have trouble with reviewing your portfolio in addition to identifying possibilities for tax loss harvesting, you might want to consider a financial advisor to help you regardless of your current investment strategy. Thanks so much for watching. I hope you liked this video and found it insightful. Click the like button if you did, and please subscribe if you haven't already. Click the notification bell so you can see when I post videos next. Feel free to leave comments, questions, and any topics you might want to hear about in future videos to get on track to being financially fit. See you in the next video.